All right. Thank you, everybody, and welcome back. So this is our final panel of the day, a very timely topic, protection gaps. The panel is Mind the Gaps, Removing Barriers to Adequate Insurance, and will be moderated by my dear friend, Andy Mais. He is the president-elect of the NAIC and the commissioner from Connecticut. The panelists will be Craig Swan, Chief Executive Officer, Bermuda Monetary Authority; Amy Bach, Executive Director, United Policyholders; Dan Kaniewski, Managing Director, Public Sector, Marsh McLennan; Margaret Peloso, Global Climate Officer and Executive Director, Chubb Charitable Foundation, Chubb Group. With that, please welcome our panelists.
Thank you all and good afternoon. And before I start, the one thing I want to do is echo what some of my colleagues have said, to thank the NAIC staff who've been here. We want to thank Ryan and the international team, Ethan and the DC team, and all the other NAIC staffers led by Andy Beal who've been here and who've put this together. I can tell you they've had to deal with people like Gary, which is not easy. But they've done a wonderful job, and I want to thank them all for this. Now, I'm pleased to be moderating a panel on protection gaps and to be joined by a great lineup of panelists, as you've just heard. Craig Swan, Craig and I have been on a bunch of panels together. Amy Bach, Dr. Dan Kaniewski, I can do that.
Dan, yeah.
Dan's got a doctor, another doctor, Maggie Peloso. How are you? And so clearly, we saved the best for last. Now, we're seeing more and more attention being placed on the need to address protection gaps, and rightly so. I think my colleague Dean Cameron is over here. Jonathan from the IIS may still be here, and that's one of the Dean is on the Protection Gaps Task Force at the IIS. So it's not just at a national level, it's an international issue that we've seen, that we've been trying to address. And just a few weeks ago, the IIS released a public statement on the role of insurance supervisors in addressing natural catastrophe protection gaps, describing the challenges presented and the steps it plans to take. The risks and the challenges individuals and businesses face continue to grow, whether it's from natural catastrophes or, as we just heard earlier, cyber, longer lifespans, and so on. This makes it crucial to ensure the availability, the affordability, and the accessibility of insurance products for consumers. Identifying, addressing, and mitigating the protection gaps is a group effort. It is holistic. It is not simply up to any one area. It will involve supervisors, it will involve industry, other stakeholders like consumer groups more broadly, and certainly it will involve policyholders. And while the form gaps take and their solutions may vary across jurisdictions, and it is important for us to learn from each other, and that's why we've got this distinguished panel here today. For this panel, we're going to be diving into a number of questions on the types of protection gaps, their sources, and what possible solutions may be out there, both within the insurance sector and also, at least for us, in our role as insurance supervisors. I don't have the answers to these questions, otherwise I'd be on the panel. But our panelists, I'm hoping you guys have all the answers. So with that introduction, I'm going to get started. And my first question is going to be, in March, the Global Federation of Insurance Associations, GIPIA, published a report, Global Protection Gaps and Recommendations for Bridging Them. The report identified 4 major protection gaps: pension, cyber, health, and natural catastrophe. Now, I'm going to start asking questions. Well, the first question I'm going to ask is to the audience. If you go to Slido, you will see there is a possibility to answer. What we want to hear from you is, what do you think is the most important of these protection gaps? Or is there another protection gap that is most important that has to be addressed? If you fill it in, we're going to get a great sound cloud, and after we're done with our discussions, we'll let you know. So I'm going to start with you, Craig, just to give you a fair warning. Now, of the 4 gaps, which do you think is the broadest gap and which is the most important to fill?
Okay, thank you. First of all, hello everyone, and thank you to the NAIC for the invitation. It's an honor to be with this distinguished panel here, and always great, Andy. The report identified pension to be the largest protection gap, with an annual protection gap of $1 trillion, I believe. And then in the order of magnitude, it gave cyber, health, and then natural catastrophe with protection gaps of 0.9 billion, 0.8 billion, and 0.1 billion. But you didn't ask me what was the largest, you asked me what was the broadest. And that then opens this up to a debate, and we all could give different responses, including the audience, because you asked them too. But I would define the broadest as being having the potential to impact everyone at all ages, across all ages.
Especially old people like me.
Like us, like us.
Oh, not you.
Having said that, with that definition, I would select natural catastrophe. Now, natural catastrophe in the upper middle as well as the high income countries, there's been some progress in terms of narrowing that gap. But those countries are experiencing the costliest natural catastrophes, and there's still a lot of the economic losses that remain uninsured. And then when you go to the middle and lower income countries, for some of those, the natural catastrophe protection gap is in excess of 95%. So when you know, in terms of both geography and across ages, natural catastrophe as a protection gap is pretty formidable. In terms of which would be the most challenging, I would have to go to a different risk. And sure. There I would go to cyber. And the reason, and again, this is debatable, but the reason I would select cyber is that it's estimated to be about 90%. And when one looks at the fact that it's quickly evolving, it's evolving with advances in technology, and there's not a whole lot of historical data that's there. You know, it's quite challenging. I would say, even though you didn't ask that, but I would say that it is an opportunity. And what we're seeing is that there is some appetite in the Bermuda market. So we're seeing growth in cyber underwriting. Now, getting to the final part of your question, which basically, what would I add? I definitely would add pandemic. And one of the reasons why is the Geneva Association indicated that less than 1% of the estimated 4.5 trillion in the global gross domestic losses of pandemic-induced losses in 2020, less than 1% of that would actually be covered by business interruption insurance. So COVID was an indicator that pandemic risk is certainly underinsured, and there is indication that even that which was insured, generally speaking, was not well understood.
Right.
Thanks, Greg. I'm going to go to you next, Amy, but let me just have one quick follow-up to that on pandemic risk. My question is it insurable? Now, if we look at a pandemic where you really, it's a very low frequency, but potentially very high severity event, and there really isn't much historical evidence on which to analyze losses. What do we do? I mean, is this something that industry can handle, or does it require governmental intervention?
I think the question of whether or not it's insurable, first of all, I would say that at the moment it's be quite challenging. Eventually it may be, but it's not certainly. I don't believe that government can do it by themselves, and industry cannot do it by themselves. So it will require a partnership across a number of bodies in order to achieve that.
Thanks, Craig. Let me turn it to Amy now. What has the broadest impact in terms of the potential? That the ones we cited, what would you add to it?
Well, I mean, you definitely have hit the big ones. Certainly pensions, people's end of life expenses, people's post-retirement expenses, and long-term care, and all those issues clearly huge. But natural catastrophes, because climate change is, as Naomi Klein wrote some years back, this changes everything. Some people kind of see it as, kind of necessitating a fundamental sea change in what the P&C sector will cover, and then how much government is going to cover. We're all in the middle of this incredible transition period. It feels like. The COVID, the business interruption point that you just made, really, it just makes me think back, sort of an urban legend that, anything can be insured for a price with limits, right? So like there's urban legend that one of the Rolling Stones, that, they took a policy out on his, okay. So that's just an old story, proving that anything can be insurable, but within reason. So for BI,
I just have to have one. What did Chubb insure that?
I don't know.
it could have been AIG. I don't know. Anyway, my point is, in my work and my organization is, we're very big on the indemnification purpose of insurance, and we're very much looking at, understanding where insurers are, how they're seeing catastrophic risk, how they saw the business interruption claims, how they're seeing what's the increasingly severe hurricanes and tornadoes happening in places. Looking for solutions for consumers. I keep saying, well, can't we develop products that don't cover everything, but they cover some, to get the damaged entity or the person is somewhat back on their feet, is better than having them get zero. But that seems to be kind of running headlong into this argument I hear a lot from insurers, which is, yeah, but all of our claims are on the lower dollar. That's where we have the most action. So, capping the payout a la NFIP at $250K is not really going to solve our problems. So I think we for me, whenever I have a conversation with the California Earthquake Authority, for example, CEO, he's always, in this bind. He wants to sell more. We don't have a lot of people who are insured now for earthquake damage. He wants, we all want to fix that, but it's kind of this catch-22 because he has to buy so much reinsurance, on and on and on. And I keep saying, well, a little bit of first dollar coverage goes a long way. So that's where I'd like to see us going. I'm not saying that is the panacea, but I think that's where we got to go. Now, as far as there being another big problem, I don't know. I think those are some pretty big gaps that we've already talked about.
Thanks, Amy. Let's move on to Dan from Marsh Mac.
Yeah. So based on my background, you could probably already tell what my answer is going to be, but I'll say that I started at the White House doing emergency management 3 weeks before Hurricane Katrina in 2005, which is either really bad luck or it was really good that I got that experience. We can debate that. But then I outdid myself in 2017 and when I joined FEMA as the deputy administrator and started just 3 days before Hurricane Maria. I tell you that not just because of my bad luck, but I tell you it because I've been in government during some of the most catastrophic disasters of our time. I can tell you that while I was proud to serve in government, and I'm so glad that the government has a number of safety net programs to help those most in need and those who, by our definition, those who are uninsured, I also saw the dramatic difference between those who we were trying to help, the uninsured, and those who had the financial protection of insurance. It was stark, to say the least. And that's a big part of the reason that I came into private industry. And when I left the government and came into private industry, I joined the insurance industry because I firmly believe there is so much more we have to do on nat cats. Obviously, we're all very familiar with the protection gap that we just discussed, and we can debate about how much we as individual companies or we as an industry can move the needle. But I can tell you every bit we move the needle is going to make a difference, because every disaster survivor who has insurance, if we can even just do that one disaster survivor at a time, it makes a huge difference to that individual. It's a life-changing decision, having access to insurance. And obviously there are benefits to us as taxpayers and the government to have those individuals be insured and not be the responsibility of government.
Let me just follow up on that for a second. I harassed Craig. Amy, you got away this time. But you mentioned that one person that survived, that one person at a time. And part of the concern that I've seen expressed, and certainly with flood insurance, if you take a look at some properties that are, you look at a town that got hit, and there is this one property that was built to code and had all the extras, and it's standing there all by itself in a community that's wiped out. That one person, even though theoretically they still have their house, the community is gone. Should there be a broader community-wide approach to this? Does that matter?
Yeah, I mean, yes, in a best case scenario, there would be that community approach, that community would take actions based on the risks that they face. And you mentioned flood, coastal area. Clearly, all of us have that image in our mind of that coastal community and what they could do by investing in infrastructure and taking actions well before that storm hits that would reduce the overall impact. So yes, in a perfect case, but absent a community coming together and making that joint investment, even getting that one homeowner flood insurance is going to make a big difference to that individual.
Thanks. Maggie, we've been waiting for you.
I'm sure you have all been waiting in suspense to hear me say climate. But here's what I will add here. I think that framing the risk as NatCat is too narrow, right? Because that allows us to continue to participate in this conversation of, oh, it's a bigger hurricane. And then we go back to where we were. But what we're really experiencing with climate is a slower moving disaster of a shifting baseline with acute punctuations on top of that. And I think that's really important when we have the conversation about the role of insurance, because insurance is a resilience mechanism. But you're now having insurance against a baseline society that is less resilient in and of itself. If you can't grow food, if you can't move crops where they need to be, if it's too hot for people to work outside, those are all things that are going to reduce well-being even before we get to the catastrophe event, and we need to be thinking about that and planning for it.
Let me ask you that just in terms of the way that climate scientists tend to look at it and how we react to climate change. Mitigation, adaptation, migration. For the most part, we're not at the migration stage yet. But what can insurers do? What would you propose at Chubb to help with that mitigation and adaptation?
So I think there are a couple of really important things we can do. First of all, the environmental community for a long time has not wanted to talk about adaptation because it was seen as giving up on climate mitigation. Mm-hmm. Climate change is here, so we have to do both, right? And I think for us, when we think about the kinds of things that we need to do, first and most important, we need to be an honest communicator about the science. Particularly here in the American context, there's some really fascinating sociological research that shows that the average American is more likely to trust what a corporation says about science than what a politician or other communicators might say to them. There's a crazy study where they looked at McDonald's, they basically said to people, how do you feel about cage-free eggs? And then in another group, they said, how do you feel about McDonald's using cage-free eggs? And if the subjects were told McDonald's was using cage-free eggs, then of course we should all use them, and that was a good thing. And it crossed partisan lines, right? That was where you really got away from some of the partisan rejection of certain kinds of science. And so I think we in the insurance industry need to think really, really hard about the privileged position we have to communicate about science and risk, because people are really bad at understanding it. The other piece of it is, of course, we have to decarbonize this economy as quickly as possible. And I think for us, we view our responsibility as both continuing to support the energy sources we use now so that there is stability, so that there is development that is a fundamental human right. And to Craig's point, right, if we do not help people who don't have access to energy as a fundamental resource get that, they're going to be worse off. But we also have to think about innovating our business so that we can support the newer solutions that are coming online.
So just picking up on that, that was a great point. Now, as you know, I have two hobbies. One is software development, and the other one is sports, right? I stopped watching sports for a while.
You thought insurance people were bored.
I stopped watching sports for a while because I didn't want to be reminded of the disappointment of the Super Bowl outcome. But now I'm back, I'm watching it. And so where am I going with this? Companies, as you mentioned, companies can do quite a lot for climate. When I think about how I got here on an airplane. Athletically, I could have swam, but that just would have taken a while, right? So I got here on an airplane, and I doubt that the airplane was using renewable energy. So there is a transition, but what we're seeing from many companies, including the Philadelphia Eagles, so I can forgive them for the disappointment of the Super Bowl, but one thing I'm very pleased with what they're doing as a long-term Eagles fan is they are offsetting their carbon footprint. So one of the things that they're doing is they are investing in the restoration of mangroves in Puerto Rico. And the importance of this is that, and initiatives like this, is that when you think about the mangroves, seagrass, salt, marshes, et cetera, they are a first-line offense for hurricanes. So, they capture a lot of carbon. They pull a lot of excess carbon from out of the atmosphere. And so, when you think of global warming, et cetera, they start to counteract that. They pull energy from the waves. So when you think of hurricanes, et cetera, it diminishes that. So essentially, we can't go to zero immediately. There isn't the technology, the infrastructure to do that. But we can start as companies thinking about our carbon footprint and starting to offset that.
Let's step back a bit from the, I don't want to say narrow focus, but climate change, which is one of the identified risks, and look at the broader picture, the broader protection gap. And the hurdles to addressing the protection gap, and I've kind of heard it here, usually boils down to one of three things: issues with access, availability, or affordability. And in many cases, availability and affordability translate into the same thing. I was just reading a brief piece in one of the trade magazines today that said, I think it was 17% to 18 to 34-year-olds in the U.S. went without auto insurance last year because it was too expensive. So we've got access, availability, and affordability. There's a lack of understanding of the risk to which we're exposed. And I look at that very broadly. As somebody from a state with significant coastal exposure, the NFIP take-up rate simply isn't where it should be. Same thing with earthquake insurance you mentioned in California or in Missouri. People tend, if you have those events that are not immediately obvious, they push it off and you get something more important. And then, of course, as was mentioned just recently with regards to the pandemic, policy wording that limits coverage. We've heard it time and again. We don't always read our policy, and we don't necessarily know what it doesn't cover until such time as we need it. So the question is eliminating all of those hurdles possible, A? And if not, how do we mitigate that? And Amy, since you got away with only one question in the first round, I'm going to you first.
Excuse me. Thank you. Yeah, so right before the panel, I was just finishing editing a tip that we're putting out for people about flood insurance. And as a consumer organization, it has gotten a lot harder for us to feel like we are giving advice that's practical for people, right? Home insurance prices have been on the rise. The NFIP unrolled 2.0. I understand why, but it's causing a drop in people, buying flood insurance. And I think, everywhere I go, I'm hearing about there being more people who are going bare, if they've paid off their mortgage. And obviously that's not good. And I think, my organization is very much in favor of basic standards, essential protections, to prevent the kind of sort of fundamental protection gaps. But obviously we're talking about two different things, right? When we talk about protection gaps, we're talking about the risk is excluded, or we could be talking about, such as flood or earthquake, or we could be talking about the gaps that are increasingly developing related to strategies that insurers are implementing, such as high percentage deductibles, split deductibles, multiple deductibles, roof deductibles, and then limitations on paying to restore things whole cloth. So I think, I understand the thinking of an insurance executive or, somebody who's following a prescription from McKinsey or some other business consultant. This is how you deal with the situation. But I think that, we've got to maintain essential protections. And there's going to be protection gaps. We're not going to eliminate them, right? There always have been. But I think now our challenge is to really call insurers to task to say, okay, we understand this pandemic took everybody by surprise, but a lot of businesses did pay a lot of money, for business interruption, and there's no question that their businesses were interrupted. And in Europe, we did see some of those claims being paid, while here it was the biggest slaughter policyholders have seen in my professional lifetime.
Well, let me ask you this. Let me just follow up, because what I thought I heard you say earlier was that insurers could offer products that were not necessarily perfect, but could mitigate the damage, reduce the needs. And if I'm an insurer, what I'm going to say to you is I'm able to offer a high deductible product or a coastal homeowners policy with a percentage deductible product so that it can be affordable. And yes, we know it's not perfect, but that's the consumer's choice, and that helps. Where do we draw the line? Where would you draw the line there?
I'd like to see us flip the script, but that's because what people want when they've been knocked down is they need cash, right? The high deductible for a lot of people means they don't get anything, right? That's what's happening to a lot of people in Florida from Ian. And so again, I understand why an insurer would say, we prefer the higher deductible. I would prefer them to cap the total benefits I would prefer to see that as a way of limiting exposure, okay, rather than having it cut out of the bottom.
Thank you. I'm going to move over. Next question is going to be for you, Daniel. Beyond offering products, what other things can the insurance industry either offer or leverage when it comes to addressing protection gaps?
Well, whether I was in government or in the insurance industry, I saw myself and I see myself as a risk manager. And as such, I think that all of us, all the way down to the pointy end of the spear with the agent dealing with the homeowner or the business owner, should view ourselves as those risk managers and helping our clients make sure that they are not exposed unduly so to these risks that we're aware of and they may not be. Now, obviously, I would say, maybe it's not obvious to everyone, I think it's most effective to be that agent on the ground who understands that community, who hopefully understands that community's risks, and can put those risks in an understandable context for their client. Now, where it rains, it can flood. It's easy for me to say, right? We've all heard it. It's what we said at FEMA. And therefore, everyone needs flood insurance. But that individual homeowner, without the context, may not even understand that flood insurance is necessary. And then there's the question of affordability. But if you look at it as a risk manager, you're not just selling your client a product. You're trying to show that you're looking out for their best interests. So in addition to insurance, even different lines of insurance, it could be hazard mitigation, right? If your home is in, an area at risk for tornadoes, I hope that you as the agent would be explaining to the homeowner that you can take some relatively affordable steps to better protect your home against wind risk. Now, if it's flood, it's probably going to be more expensive. We all know it's not cheap to mitigate against flood risk. But then again, there are grant programs out there that are available at the community level and certainly at the state level that community and maybe even that homeowner could access. But again, it's up to us in the insurance industry as risk managers to help explain that to the client and ideally help them protect against the risks they face.
So you see it primarily as an education issue?
I think it's a necessary first step.
Thanks, Dan. Margaret, I'm going to turn to you next. And you mentioned climate change going, and I'm just going to call it net zero. And this is, as we move to a carbon neutral economy, the goal is laudable. We know there are concerns along the way. If I were working in an oil well in the Gulf of Mexico, I may not be quite as thrilled. If I were, to have my revenue as a governor of an oil-producing state, I may not be quite as thrilled. So as we move to transition to net zero, what opportunities do you see and what challenges that will need to be addressed?
So,
and you only have 20 minutes.
really, I was going to say, I teach a whole semester-long course on this, so I will try to give you the short version here. I think that the first real challenge with net zero is honest communication, right? We have seen a trend in corporate America more broadly and in the insurance industry more specifically of making net zero commitments. In my prior life before I joined Chubb, I was an outside corporate lawyer and I worked with a lot of companies, and I would work with companies who had these commitments, and I would go to their boards and their CEOs and I'd say, what does net zero mean? And they would stare at me blankly and say, I don't know. And I'm going, well, why did you make this commitment then? And I think that was because we lived through an era of ESG where it was relatively easy to tell your shareholders pretty things they wanted to hear without rolling up your sleeves and thinking about what the hard work was going to be. The problem with that is now, when we try to talk to people about this stuff, they assume we're lying. So I think that we need to be having more constructive conversations about what the role of our industry really should be in net zero, right? If you're an insurer and you make a commitment that you're going to reach net zero in your underwritten emissions, you're doing one of two things. You are either, number one, making a commitment, betting on how quickly the global economy is going to decarbonize, and you are praying that it goes at least as fast as you have assumed it will, because otherwise you're not going to make it. Or you are making decisions right now that you are going to systematically withdraw capacity from high-emitting industries and shrink the available market. That approach I think is really challenging because when you look at some of the evidence that exists from the banking industry, there's a great article about this in the Wall Street Journal today. When large corporates who have these bigger ESG policies withdraw because of these climate policies, what you tend to see, particularly in the energy space, is those resources still get produced, and they get produced in a less responsible way. So the short-term emissions are actually higher. And so I think we need to think about how we can meaningfully engage in transitioning the economy. The other thing I would just say briefly is that because of the rate at which the economy needs to decarbonize, we are going to need all kinds of new technologies, right? And we're seeing governments pour a lot of incentive money into that. For us as an industry to really meaningfully participate in that, we're going to have to change how we do business. We don't have the luxury of waiting for the kinds of loss histories that we would typically like, and that's something that we at Chubb are really grappling with right now, is how do we facilitate that transition.
Anyone else want to jump in on that one? Before I turn to Amy with the next question. Amy, you're on the spot again.
Good, but don't ask me about greenwashing. I don't know what that is.
Not going to ask you one of those. Yeah, I'm going to ask you about stuff happening in California, because California has been one of the leaders in a move towards using parametric products to address the impact of climate change. So based on what you've seen there, how viable a solution do you consider parametric products?
I think it's a good kind of paired, if we're going to continue in this direction of high deductibles, parametric can be a palliative, but it doesn't take the place of traditional insurance, and it's very bite-sized. But I do know, for example, one of the innovators in the parametric space has been trying to get FEMA to buy, to sort of do a deal where FEMA will essentially buy those products for people. Certainly, arguably more efficient maybe than just giving a grant, individual assistance grant. But I think parametric has promise, but not as a standalone.
Anyone else?
I would say, parametric is one of those tools in the insurance toolbox, right? It's something we need to look at to help us close the protection gap, because quite frankly, if we don't look at alternative risk transfer mechanisms, we're never going to close the protection gap, is my view. I can give you one specific example of how parametric was put into play in a rather innovative way, I think, with one of our subsidiaries, Guy Carpenter, together with the City of New York and several other nonprofits. In fact, the parametric is actually placed with an NGO as a derivative, and it's for flood. So it's a community, it's actually several communities in New York City that are low to moderate income households. And if the criteria are met in the parametric trigger for flooding, those households would receive an immediate cash payment, no deductible immediate payout. So I think this is somewhere where it's parametric and it's not perfect, but it's filling a gap, and it's maybe one area where Amy and we might agree that parametric has a significant role to play on that, as you said, first dollar payout, immediate payout, and frankly, much faster payout than FEMA would with its traditional individual assistance program.
Yeah.
Let me move on to you, Craig. Capital is important. Unless we have capacity, the industry can't provide coverage. And Bermuda has been central to providing reinsurance and insurance-linked securities. What role would you see those tools playing in the attempt to address the coverage gaps, and not just in climate change, but in general?
Yeah, in general. So reinsurers provide insurers with additional capacity so that insurers can cover more risk. And as a result, obviously, they are closing the protection gap. And reinsurers, this is being achieved by reinsurers pooling risk. And as a result, insurers have access to a wider and more diversified capital base. The OECD, they did a report on reinsurance markets, and they were identifying some of the risk management benefits that reinsurers help insurers with. But when you're talking about, one of the areas they spoke about when you're talking about cross-border reinsurance is you can consider it, similar to what you were saying, you can consider it as another source of capital in terms of enhancing recovery as well as reconstruction efforts. And also what happens is it creates a symbiotic relationship between jurisdictions. So just as an example, between 1997 and 2020, the Bermuda market paid over $400 billion in claims to the US. And when you think about even just that last 5 years, it was actually half of that. So the last 5 years, there was $400 billion from 1997 to 2020, but $200 billion of that was from 2016 to 2020. And when you think of the record loss year of 2017, Bermuda insurers paid 30% of the claims that arose from Hurricanes Harvey, Irma, and Maria. And I heard some of those hurricanes mentioned by the panelists. And even last year, with Hurricane Ian, it's estimated that Bermuda may be paying up to 25% of those claims. And so basically, reinsurance, it adds to capacity of insurers, allows them to take more risk to close protection gaps, and creates a symbiotic relationship amongst jurisdictions. When you're thinking about the capital markets, it's actually over $100 billion in assets in the capital markets. And insurance-linked securities is a way of actually tapping into some of that capital. So all that capital is not necessarily residing in a reinsurance company, but it allows insurers to tap into the vast capital markets and actually bring in additional capital to assist with some of the challenges that we've been discussing at a very low cost.
Let me go back for a second, and I'm going to go back and let me mention again the four major protection gaps that Jafia identified: pension, cyber, health, and NatCat. And certainly what I've heard here is that there is a significant need for education. As we go through these, perhaps cyber is maybe one of the most obvious, where certainly in my experience, insurance companies have moved from simple risk transfer to risk mitigation as a way of reducing the overall cost, and that way of reducing the cost both to the insurers and to society. But if you look on it broadly, who's got responsibility for educating those consumers, for helping them understand as we go back from either the broader policy or the fact that wherever it rains it can flood? Who's got that responsibility? And Craig, I'm going to start with you as a supervisor. What do you think the supervisor's responsibility should be?
The supervisor's responsibility will largely depend on the mandate of that supervisor. And so essentially, supervisors fall into three buckets. You have those who are primarily prudential, and for them, their role is to ensure, not to ensure, you can't ensure anything, but their role is to have reasonable assurance that an insurer or a reinsurer is going to remain solvent in order to meet its obligations. And then you have those who are a mix of conduct and prudential. So in addition to solvency, they're going to be focusing on fair outcomes and education and those types of things. And then you would have those like the Financial Conduct Authority in the UK, who are conduct regulators. So depending on the mandate will dictate what the role is. But minimally, I believe that all supervisors should require that retail products are explained thoroughly before they're actually sold, and that there isn't any mis-selling that occurs. But those on the conduct side will engage more in education, as well as financial literacy. One of the considerations at the BMA is us partnering with the local chapters of the Chartered Financial Analyst Association, as well as the Chartered Professional Accountants Organization, to prepare financial literacy material. But it's not just a supervisor's responsibility, it's everyone's effort. So basically, I believe that supervisors as well as industry should be educating policymakers and legislators so that there's appropriate legislation to facilitate access to products that cover risk. But also industry and policymakers should be educating consumers with respect to their options around products, risk prevention, risk mitigation, et cetera. So it's a everyone effort.
Now, industry should be a part of this, and I'm looking at you, Maggie, and you, Dan. I'm going to start with you, Maggie. What do you think industry's role should be? What's your responsibility?
I think that we all have a significant responsibility to educate, and I think the education actually has to come earlier in time. Craig, it's a very well said point that coverages have to be clearly explained at the time of purchase, but when you look at the social science and behavioral economic literature around things like climate adaptation, regulators have tried things like when you go look at a coastal home in Texas, you have to sign a piece of paper before the realtor can even take you out that says that you understand you're buying in an area where if your house gets washed away by a hurricane and it's now beach, it's not your house anymore. People sign those papers, they go buy houses, and then they act shocked when it's not supposed to be their house and it becomes a huge political issue. And so I think that as we think about increasing literacy, financial literacy is a huge part of it, but also science literacy, literacy around these broader gaps, interacting with potential insureds only at the point when you're trying to bind a policy, that's way too late to be having that conversation.
Dan, how about you? You've been on the government side and you've been on industry side, or you are on the industry side.
Right, yeah, on the industry side, I certainly agree 100% with Maggie. On the government side, I think, just to be clear, FEMA is not all of the emergency managers in this country, right? There are emergency managers in every community in this country. So there are federal emergency managers, there's state emergency managers, there's county emergency managers, there's local emergency managers. And those emergency managers are quite capable of explaining what emergency management brings to bear. And oftentimes, those are exclusively government programs. So while good, it's good to educate a community on the government grants you can get to strengthen your infrastructure in your communities. It would be even better if those emergency managers were educated on the tools we have in the insurance industry. And so when I was at FEMA, I brought together, including some of you, state insurance commissioners together with state emergency managers, and John Huff's laughing because he was part of that. And so bringing those emergency managers and those insurance industry executives and government officials representing the insurance industry and regulating the insurance industry was really important, and it's still very much formative though, right? The same way that emergency managers, because there's tens of thousands of them, many of them still have a blind spot when it comes to insurance. I would argue the same is true in industry, in the insurance industry. Many of us have blind spots on what the government can bring to bear and how it can support and redouble some of the efforts that we're all trying to do in our industry.
Thank you, Amy. Now, you wrote Wise Up, a Savvy Consumer's Guide to Buying Insurance. And your awards include being named a Money Hero by Money Magazine. So let me ask you this, from the consumer side, you've been a long-time consumer representative of the NAIC, what's the responsibility of the consumer? Let's say the regulators are saying, this is what you should be doing, this is what you should be looking at. Industry, whether it's from the company or from your broker, is telling you, hey, these are the concerns that you have. At what point does the consumer have to take responsibility for that consumer's choices?
Well, I think consumers certainly have a responsibility to protect their own assets and to make reasonably informed decisions where they can. I think the NAIC has been doing really good work for quite a number of years to try to get messaging to insurers that really. It would be great if you would advertise a little more candidly that not every insurance policy covers everything, that there are differences between policies, but also I think collectively we are all trying to develop ways of having notices and disclosures that are in plain English, that are at a reading level. They have to be paired, in my opinion, with essential protections or basic standards below which coverage should not be allowed to fall. But I do think consumers do have an obligation, to mind their own stuff and not think that somebody else is going to, make all their decisions. It's just a very tough product to shop for. I think we all know that. And since no panel seems to be able to avoid talking about AI, I would say we are seeing more tools that are available for the more sophisticated consumer to help them distinguish between policy forms. And I think we're going to see more sort of AI being able to penetrate the wording and the language and the exclusions and help consumers that understand that there are differences, that just having the insurance is not, doesn't mean you have enough or the right kind. So I think it's just a work in progress, I'd say. It's a shared responsibility. And I think we are all looking for better ways to help people make good decisions, because just like, the surprised homeowners in Texas, or former homeowner in Texas, we get this after every wildfire. Well, I thought I had full insurance, and it turns out I didn't.
Let me just follow up on that. And again, I'm not going to go to the AI part, but I think that's, if I heard you right, we're trying to help consumers understand what the limitations of their policies are, what the limitations of their coverage. And just looking at the way things are right now, we've got regulators, we've got legislators who've been mandating, who in some cases have actually scripted disclosures for consumers. Do those work? Do those help close the coverage gap?
I think we just went through a whole debate in Colorado whether we had to have a declination form at the point of sale, where the consumer had to sign, I am rejecting the extended replacement, or I'm rejecting this additional code upgrade coverage, versus just having it be on the deck page after the policy's been bound. And of course, I was advocating, I really think you have to force the awkward conversation, because we know that consumers are price conscious, and we know that agents know that, and we know that insurers know that, and so often that conversation doesn't really happen about, well, actually, there's some fine print here, but if it doesn't happen before the policy's bound, then it's basically doesn't matter. So it's all about pre-sale disclosure, in my opinion.
Well, I would add, Andy, that, and I heard it touched on, there's also, we may assume that human beings, and to a degree we are, but we may assume that human beings are rational. And, that's not necessarily the case. And so, you could educate us that insurance is good, but still insurance is viewed as a discretionary good. A young person may know that, yes, I should be saving up for my retirement and my pension, et cetera. But essentially, they may have, and even in other areas, may have some other priorities. So theoretically, we may know. But, it's important to, it's more than just education. So the entertainment industry has studied psychology, and even beyond entertainment, companies and their marketing strategies. And, some of them could be unethical, so we don't want to go there. But in our education, it's not just a tick the box. We educated, we told someone, they ticked the form and said, yes. It's actually more than that. And, we can't negate the fact that we're not all rational. We're not,
Or we don't all act rationally.
Speak for yourself.
all the time. Yeah, okay. Well, we know you're different, but...
So this is an international insurance forum, so I've got to ask an international question here. I can see Director Lindley Myers looking at me, so I have to respond to her. She is my leader, and I adore her. Yeah, I mentioned Director Cameron's still sitting over there. Director Cameron represents us on the Protection Gaps Task Force at the IIS. The OECD, the G7, everybody's been looking at the protection gaps. But as I think the director will tell you, even where we see the apparently shared gap, the impacts may be local, and the tools to successfully address those may be local. So with that in mind, and I know we've got lots of our international colleagues and companies here, what do we do on an international level? How do those organizations and other international stakeholders play a part in reducing the coverage gap? And let me just start with Daniel on this one. Dan?
So on this one, I'll put a plug in for OECD, because in my government time, I was elected chair of the OECD High-Level Risk Forum. And if you're not familiar with it, you should look it up. It's the HLRF has the risk managers from all the OECD member nations, and by public risk managers. And by that, I really mean emergency managers. I really mean the FEMA director equivalents from all those countries. And I noticed before I had taken the helm of the organization that they really focused on the traditional emergency management topics. And what I mean by that is the emergency management approach, the response and recovery to disasters. My goal for that group, and a goal I think that group has kept up, has been to look more broadly at other industries and to look more broadly across all countries and see where those truly best practices are from those other countries. For example, who knew, I didn't before I chaired this group, that a number of your countries mandate flood insurance. Like the situation we have with flood insurance being optional is maybe something relatively unique. And then you can go down the list with earthquake and other perils about those in other countries you could never conceive those being optional. So mandatory offer is something that, obviously I would love to see here in the US. Mandating it might be too far for here in the US. We can debate that, but there are countries that have achieved this. So seeing some of those good practices across those nations was very eye-opening. In fact, I went to the Netherlands and saw, if you want to talk about flood mitigation, that's the place to go, right? I mean, for hundreds of years, they've invested in that infrastructure. But you know what they're not very good at? The other elements of resilience. And that's why we were there. We were there to help them as much as they were to help us. Preparing for flood events, for evacuating from potential flood events, and insuring against those flood events, they would admit, is not their strength. So it was really a symbiotic relationship.
And on the flip side, U.S. companies tend to take the lead in cyber insurance, for instance, trying to help reduce that coverage gap. So there may be differences among countries, among areas, as to what they can probably do or do best. I'm just going to ask you to follow up, Craig, because you're from Bermuda. How do you address the issue in Bermuda?
I'll actually transition that to the IAIS. Bermuda is a very small market. It's only 60,000 of us, and coverage is really high. And also it's a hilly area. It's a lot of hills, and so there's not a whole lot of flooding. And if you're going to have a mortgage, you actually need to be covering your house, your home for these things. But in terms of the IIS and the usefulness of these organizations, they primarily bring about awareness of the issue around gaps and provide a think tank in terms of best practices and how to deal with this. In April of this year, the IIS published this circular, I think it was mentioned earlier, about its commitment to assist insurance supervisors in dealing with protection gaps. And they will, by the end of the year, publish a report, and that report will contain what supervisors around the world, what IIS members are actually doing, what industry's doing, and what other stakeholders are doing in the areas of protection gaps. And I would expect that the report would include items such as the availability of risk analytics and data with respect to analyzing catastrophe risk and protection gaps around good practices in terms of the implementation and design of private-public partnerships around dealing with protection gaps, as well as financial literacy, risk prevention, risk mitigation, et cetera. So, stay tuned. Before the end of the year, there should be guidance with respect to a lot of the issues that we are discussing up here.
Excellent. We'll be looking out for that. I know we're coming pretty close to the end, and I just want to get in a couple of audience questions if we could. Top questions, and remember, you can go to Slido and just either put in your own question or vote one of these questions up or down. The top question right now is from Ronan at Insurance ERM, and he says, why is ESG, and I'm presuming it's a he, my apologies if it's not. Why has ESG and climate risk been allowed to become politicized in the U.S.? Do insurers need to be more vocal on ESG risk and opportunities for society? I'm not sure that on here we can answer the first part of that question, but the second part, do insurers need to be more vocal on ESG risks and opportunities? And Maggie?
All right, I'm going to answer the question with a question. Please raise your hand if you think you can define ESG in less than a paragraph, or would have the same definition as anyone else in this room. This is the fundamental problem, right? The financial sector got really lazy about correlating ESG with returns without defining what ESG really was. It turns out that by doing that, what they generally did was build funds that were exclusionary of energy and defense. If you were not in energy and defense in the US stock market over the last 18 months, you got killed. You did not perform anywhere near as well as the market did. And so what that did was it created a real opening for the ESG skeptical to say, look, this is not consistent with your fiduciary duty. So we continue to see this movement towards better defining what ESG is to figure out, is it a driver of alpha? Are there smart betas in there in the financial sector, right? I think the problem for us as in the insurance industry is when I talk to investors, I spend most of the time saying, I'm not a bank. Do you understand that I am not a bank? And I think that what has happened to particularly public insurance companies is that because people lump us in with banks and treat us that way, so much of the ESG oxygen is getting consumed by, will you make these kinds of pledges? Will you promise me this kind of thing? Will you go count that? In a way that is completely uncorrelated from the kind of risks that we as insurers face and are trying to protect our companies from. So yeah, I do think we need to be more vocal, and it's something that we've really been working on in refining our own communication, particularly around climate, and talking with investors, with insurers, with anybody who will listen to us about connecting what we're trying to do on climate with the quality of the risk.
Thank you. I'm going to go to the next question now, and let me just see. Dan or Amy, who should get this one first? Because I think you both might have some insight onto this. And the reason that I say that is because I'm thinking of flood insurance and this is completely unrelated to climate change, just basic flood insurance. And the fact that so many times you will see there is a catastrophe, and what happens, it doesn't matter whether or not you have flood insurance, because especially if it's near an election, the government is going to come in and pay anyway, which is why the NFIP have a huge deficit. So the question that we have in front of us is, does government assistance to the uninsured incentivize homeowners and businesses to remain uninsured? How can government assist without the disincentive? What do you think? Who wants to go first?
I'm happy to, but Amy, go first.
I'll go first and then you, yeah, okay, that's great. I do think there is a lot of frustration among those who bought insurance that, why are these people who didn't buy insurance, getting, but there isn't actually, some of that is just a myth, really, because I mean, individual assistance grants average 40, what is it? The average 5 or 6,000. So it's not like people are making bank off of a FEMA grant, and SBA loans have to get paid back. So I think that it does rankle a lot of people, including myself, when we see some of these grants that get made available in disaster areas going to people who had no insurance. But I think FEMA has tried, and I certainly they have said, and I think they've been enforcing the rule that if you get flooded and you get a grant and you don't go and buy insurance after, and then you get flood again, you're not going to get more money. So I think that's kind of been that's a reasonable approach.
Yeah, I agree with Amy, and it really does come down to public education before the disaster happens. If you make it clear that if a flood happens or some other significant disaster and you don't have the proper insurance, you might get FEMA assistance, highly caveated, like there has to be a presidential disaster declaration, you have to meet certain guidelines, you have to be denied for an SBA loan, Small Business Administration loan. That's contingent on you even getting FEMA assistance. Many people don't realize that. And you have to be uninsured. So if you meet all of those criteria, then you might get a few $1,000s, right? Now, I think if homeowners knew that ahead of time, they might make a smarter decision, right? And that's how you really get rid of that disincentive, because that program should not go away. I don't think any of us would say. You need these safety net programs, but you need to educate ahead of time to make sure that people make the right decision and protect their financial future.
Right. I mean, I would, my organization has a preparedness program. We are actually now partnering more and more with state departments of insurance to do joint rack cards and things. We're doing that in Minnesota, Wisconsin, other places. And one of the first points we always make is government's not going to come riding in on a white horse. And, we don't say it quite that way, but we say that insurance money is the most effective way of recovering from a disaster, not government aid.
Lightning round, 10 seconds each, literally, because otherwise we're going to get kicked off the stage. That last question, what's the gap landscape going to look like in 10 years? Do you foresee positive progress? And we'll start with Craig and move to the left.
There will be positive progress, but it depends on really which gap. And so there was a question earlier on, it just disappeared, about AI. And cyber is the cyber gap is, or the complexity of cyber is kind of growing with technology advances. And so will that be quicker than certainly insurers will write more, but will that gap be decreased? It's hard to tell, but certainly there will be progress. Some gaps will be narrowed. We're seeing the narrowing now, but depends on which risk.
Amy?
I think we're going to see a lot of action in government-supported insurance plans of last resort. We're already seeing that. But I think there'll be more coordination there, and hopefully ensure the collaboration that you see on fair plans, that sort of thing, where you're tapping both sectors. Including also things like the Florida Hurricane Cap Fund having more publicly supported reinsurance.
Dan, and it's flashing red, so.
Yeah, I'm going to try to be optimistic and say because of the innovation we're just starting to see, on alternative risk transfer and other methods in NatCat, that we will start to make progress. But before you get too excited, I'm going to turn to Maggie, and she's going to tell you why I'm being overly optimistic, because the increasing frequency and severity of storms.
You got the last word.
I actually will end on an optimistic note. Look, I think that with NatCat, things are really changing because as people experience more disasters, they internalize them better. So while the impacts are going to get worse, I'm hoping that the protection gaps will get smaller because people will really understand the risk they're facing.
Thank you all. Thank you to this great panel.